Susan spent 32 years as an ICU nurse in Cleveland. She retired 3 years ago and moved to Naples, Florida with her husband, Tom, a retired union electrician. They worked their entire lives. They saved carefully. They watched a CPA file their taxes every year for 18 years. When their daughter Rebecca got divorced in Atlanta with 2 teenagers and a mortgage she could not keep current, Susan and Tom did what most parents would do. They helped. Each of them gave Rebecca $19,000 a year, the IRS gift exclusion limit, exactly within the rules. Their CPA confirmed, no gift tax return required, no taxes owed, fully legal. They did this for 3 years. Total gifted $114,000. 8 months after their 3rd year of helping, Susan had a sudden hemorrhagic stroke. She was 72. She survived. She needed full-time memory care. Average cost in Florida, $11,200 a month. Tom applied for Medicaid, and the state opened a 60-month look-back review. The Medicaid review found every dollar of the $114,000. The IRS gift exclusion that Susan and Tom had carefully stayed within meant nothing to the Medicaid program, which operates under a completely separate set of rules that their CPA had never mentioned. Florida calculated a Medicaid penalty period of 331 days. During those 331 days, Tom would pay Susan's $11,200 monthly memory care bill out of pocket. He liquidated their IRAs. He listed the house they bought together in 1991. The IRA distributions pushed his Medicare premium up $300 a month for the rest of his life through a separate rule called IRMA. 3 financial penalties stacked for one decision Susan and Tom had thought was simple. Nobody had told them. Their CPA confirmed the IRS rule. Their CPA did not mention there was another rule. This is for informational purposes only and not financial, tax, or legal advice. Please consult a qualified elder law attorney and a tax professional for your specific situation. My name is Robert Pause 2. 0S, your guide to the retirement decisions that quietly punish families for doing what they thought was the right thing. If this is helpful, hit subscribe. Robert covers the financial traps that exist between the rules, the ones your CPA does not know about because they are not in the tax code, and the ones your financial advisor does not know about because they are not in the brokerage handbook. Today, Robert is going to walk you through the 60-month rule that operates entirely separately from the IRS and that is running on you right now, whether you know it or not. He is going to explain the carryover basis trap that costs your children more than the gift you intended to give them. And he is going to show you the 4 words that change every conversation with your elder law attorney before you give another dollar to anyone. There are 3 traps. Susan and Tom hit all 3. Most retirees who try to help their adult children hit at least one. By the end of this video, you will know all 3 by name. Trap number 1, the 60-month rule. The IRS gift tax exclusion in 2026 is $19,000 per recipient per year. A married couple can give $38,000 to a single recipient without filing a gift tax return. Anyone can give this to as many people as they want, 3 children, 7 grandchildren, 2 neighbors, and owe the IRS nothing and file nothing. Above $19,000 per recipient, you file Form 709 and reduce a lifetime exemption that is currently $15 million per person under the One Big Beautiful Bill Act, which made that number permanent. You almost certainly owe no actual gift tax in your lifetime. The IRS gift rule is generous and clear. Medicaid is not the IRS. Medicaid is a joint federal and state long-term care program with its own completely separate rulebook. When you apply for Medicaid to cover nursing home or memory care costs, the state reviews the previous 60 months, 5 full years of every financial transaction you made, every check written, every transfer, every gift. They do not care whether you stayed inside the IRS exclusion. They do not care whether you filed Form 709. They look at one question only: did money or assets leave your control during the look-back window? Susan and Tom's $114,000 in gifts to Rebecca was every dollar visible. The penalty for gifts inside the look-back is calculated by dividing the total gifted amount by your state's average daily nursing home or memory care cost, called the penalty divisor. Florida's penalty divisor is approximately $345 a day. $114,000 divided by $345 equals 331 days. That is how long Susan was ineligible for Medicaid coverage from the day Tom applied. The look back is not theoretical. According to the Federal Department of Health and Human Services, 70% of Americans turning 65 will need some form of long-term care during their lifetime, and over 40% will spend time in a nursing home. Median annual cost in 2026 has crossed $108,000. Medicare pays for skilled nursing for up to 100 days under specific post-hospitalization conditions and then stops. For everything beyond that, Medicaid is the only safety net, and Medicaid is the program that audits 5 years of your gift history. The 6-0-month clock is running on every retiree right now. Every gift you have made in the last 5 years is on the record. The clock does not reset because you did not know about it. Trap number 2. The carryover basis trap. Tom and Susan also gave Rebecca something else during those 3 years. Tom owned 200 shares of an industrial stock he had bought in 1991 for $4,000. By the time Rebecca needed help, those shares were worth $34,000. Instead of selling and giving cash, Tom transferred the shares to Rebecca directly. He thought he was being efficient. When Rebecca eventually sold those shares to pay her mortgage, she received $34,000, and then she got a tax bill for capital gains on $30,000 of appreciation. At a 15% federal long-term capital gains rate, that was $4,500 of federal tax on what Tom intended as a tax-free gift, plus Georgia state income tax on top. This is the carryover basis trap. Under the tax code, when you give someone an asset during your lifetime, the recipient inherits your original cost basis. Tom paid $4,000 in 1991 for those shares. The moment he transferred them to Rebecca, Rebecca's cost basis became $4,000, even though the shares were worth $34,000 the day she received them. If Tom had instead held those shares and left them to Rebecca through his estate, Rebecca would have inherited them at what is called a stepped-up basis under IRC Section 1014. The cost basis would have reset to the fair market value on the date of Tom's death. If Rebecca had sold the shares the next week for $34,000, she would have owed $0 in capital gains tax. The entire embedded gain would have disappeared at the moment of inheritance. This is one of the most valuable provisions in the entire tax code for middle-class American families with appreciated assets, and it disappears the moment you gift the appreciated asset during your lifetime. There is a specific exception worth knowing. If you are in a year where your taxable income is below $47,025 as a single filer or $94,050 as a married couple in 2026, your long-term capital gains rate is 0%. Many retirees in their early retirement years before Social Security is started, before required minimum distributions begin, sit in that 0% bracket. In those years, you can sell appreciated assets yourself, owe no federal capital gains tax, and give your child the cash. Same asset, same intention, entirely different tax outcome. But you cannot give an asset that has appreciated significantly and expect your child to get it tax-free. The carryover basis follows the asset. Trap number 3, the IRA distribution cascade. The third trap caught Tom on top of the first two, and this is the one most retirees never see coming until the bill arrives. When Tom started paying Susan's $11,200 monthly memory care bill out of pocket during the Medicaid penalty period, he had to source the money somewhere. His liquid savings ran out in 4 months. He started taking distributions from his traditional IRA. 3 things happened simultaneously. First, every dollar he withdrew from the traditional IRA was ordinary income to him in the year of withdrawal. A $135,000 distribution to cover 1 year of memory care became $135,000 of taxable ordinary income on top of his Social Security and pension. His federal tax bill jumped accordingly. Second, the spike in his modified adjusted gross income from those IRA distributions pushed him over the IRMAA threshold for Medicare premium surcharges. IRMA, the income-related monthly adjustment amount, uses your income from 2 years ago to set your Medicare Part B and Part D premiums. Tom's high-income year created a Medicare surcharge that will hit him for 2 full years going forward, raising his monthly Medicare premium by approximately $300. Third, Every dollar Tom withdrew from the IRA was still a transaction Medicaid would review during any future application, adding to the look-back trail and constraining future planning. If Tom had been able to source the same payments from a taxable brokerage account or a Roth IRA, none of these layers would have triggered. Brokerage withdrawals are not income events for the original principal. Roth withdrawals after age 59 and a half are tax-free. But Tom and Susan, like most American retirees, had built their savings primarily inside a traditional IRA, which made the traditional IRA the only large pool of money available when they needed it. Their gifts had eliminated the cash and brokerage cushion that would have absorbed the cost. Here is the one piece of language that changes every conversation with an elder law attorney before you make a gift. The 4 words: plan for the look-back. A qualified elder law attorney, different from a financial advisor, different from a CPA, operates inside the Medicaid framework as a default. When you walk in and say those 4 words, the conversation moves from gift tax minimization to something much more important. Structuring your wealth so that any future long-term care need is funded without creating a penalty. The 2 structures that come up in those conversations are the Medicaid Asset Protection Trust, sometimes called a MAPT, and direct payment exemptions. A MAPT is an irrevocable trust that, if funded more than 5 years before any Medicaid application, removes assets from the look-back window entirely. The 5-year clock runs from the date of funding. A trust set up at age 65 protects assets by age 70, assuming nothing changes the rules. Direct payment exemptions are simpler. The IRS allows you to pay tuition directly to a qualifying educational institution or medical bills directly to a healthcare provider on behalf of a family member with no annual exclusion limit and no Form 709 requirement. These payments bypass the gift exclusion entirely. Many states do not treat these direct payments the same way they treat cash gifts under Medicaid look-back, but state rules vary. Confirm yours specifically. Susan and Tom, instead of giving Rebecca $114,000 in 3 years, could have paid her teenager's summer tutoring directly to the program, paid Rebecca's medical insurance premiums directly to the insurance carrier, and waited on the appreciated stock until they had the right capital gains year to sell themselves. Same desire to help, same family, entirely different outcome. If they had set up a Medicaid Asset Protection Trust at 67, 5 years before Susan's stroke at 72, the assets in the trust would have been outside the look-back entirely. The home they were forced to sell to pay for memory care would have been protected. The 4 words: say them to an elder law attorney before you write the next check. Tom comes to the memory care facility every day. He brings Susan a thermos of coffee and a framed photo from their 1989 wedding. Some days she knows him, some days she does not. He has been doing this for 19 months. The 331-day Medicaid penalty period ended last summer. Medicaid is now covering Susan's care, and the state has placed a lien on what is left of Tom's assets to recover what they paid out. The home Susan and Tom bought together in 1991 is gone. The IRA is mostly gone. Their financial cushion is gone. Rebecca is doing better. The mortgage they helped her cover is current. Her teenagers are in school. She tried to return what she could, about $40,000 to Tom, when she understood what had happened, but the Medicaid penalty does not reverse retroactively for a partial return after the fact in the way she hoped it would. Tom told her to keep it. Rebecca asked her father almost weekly, "Did we know? Could anyone have told us?" The answer is yes. An elder law attorney would have told them. Their CPA could have referred them to one. Nobody did. You are not Susan and Tom yet, or if you are, you may already know what they did not. But if you are over 60 and you have given any money to your adult children in the last 5 years, the 60-month clock is currently running on you. If you intend to give in the future, the 4 words apply before you give. The IRS gives you $19,000 per recipient per year. Medicaid does not give you anything. The 2 systems do not talk to each other. The decision to give is, in most cases, irreversible. The knowledge has to come first. If this helped you, hit the like button. It takes 2 seconds, and it helps more retirees find this information. Subscribe if you have not already. And if you know someone who is helping their adult children with money, a spouse, a sibling, a friend, send them this video today, not tomorrow. Pause 2-4S today. Drop a comment below. Has anyone in your family ever made a gift and only later found out it had a consequence nobody expected? Robert reads every single one, and the most common situations become future videos. This is Robert.